What's going on, guys? In this video of Should I Invest, we're going to be talking about CVNA, a name that's been running recently, and a lot of people are asking me, should we invest in this company long term? So we're going to do the fundamentals. We're going to find out if it's the right stock for you to buy in the long term. All right, so we got our handy dandy MARKETSMITH tool that tells us everything we need to know: earnings, EPS, chart, funds ownership, everything we need to make a financial decision on whether we're going to buy this stock or not. All right, if you guys want to buy this tool, it is on sale right now. Link is in the description. You guys can grab it right there. Next thing we got is Yahoo Finance to tell us about the fundamentals of the company and see what we need to look at. And lastly, we have our handy dandy Excel sheet that's going to help us do all the adding and the subtracting and tell us if the company is a fail or a pass. All right, so we're going to plug it in right here. CVNA, we're looking at Carvana, EPS of minus 893, so that's going to tell us there's 0 PE or not available, and the return on equity will most likely be unavailable as well due to that. So the return on equity is found right here. You can see NA not available, so we're going to plug that in here as well. And then we're going to go look at total debt to total asset. All right, so we're going to plug this in from Yahoo Finance. We're going to pick it up. Total debt. All right, so we're looking at total debt right here, 6.49. We're going to plug that in. Total assets, we're going to come right here. We got 7. Perfect. All right, so we got our total debt to total assets, and we can see a positive figure here. Very, very short, but it's a positive figure. We got a 1.08, meaning our assets can cover our debts. All right, now we're going to look at current debt and current asset. All right, so how do we do that? We're going to go back here. We're going to look at current liabilities. That's 2.89. We're going to plug that right here. And then we're going to look at current assets, which is right here. We're going to plug that in as well. Perfect. And in the short term, actually, we got, a current debt to asset ratio of 1.69. Again, our current assets can pay our current debts. Now let's look at operating income. To do that, we're going to have to go to income statement. We're going to look at operating income right here. All right, so that is a minus 1.1 million. So we're going to plug that here, and we're going to look at total revenue. Total revenue for now seems to be 14 million. So 14 million in total revenue, but operating income is a minus 1 million. So that right away is going to give us a red percentage right here. Okay. Now we need to see, is cash flow increasing and decreasing? We're going to come down here to cash flow. We're going to go to the bottom. We have minus 987, minus 968, then we have minus 3 million and minus 2 million. So unfortunately, the cash flow is not increasing. In fact, it is decreasing. Next thing we want to look at is the ownership of management. How much does management own on this company? Management owns about 3%. That is right there. So it falls within the norm of what we've seen in the past here. Okay, so we're going to put 3. And then we're going to look at funds. Are the funds increasing or decreasing? We're going to plug that. We're going to find that out right here on MARKETSMITH. And let's take a look at what's going on. All right, so March 2021, 895, 952, 982, 965, 913, 826, 565, 403. What are we seeing here? We start to drop off after, looks like September 2021. The funds are decreasing, going downwards. All right, so December 2022, we can see the funds were at 400, and September 2021, they were at 988. So the funds are slowly pulling out, and the funds, in fact, is decreasing as well. So that's going to give us a big fat fail, simply because there wasn't enough things checked off here. Not much in the red, not much in the green, I'm sorry. And the Excel sheet is going to give us an absolute fail here. Okay, so let's take a look at the chart and explain a few things here. All right, you got to understand that these names that are growth stocks that are fairly new, the fundamentals is not really going to make sense right now. They are higher risk names, and therefore you need a higher risk portion in your portfolio. You could have a portion of your stocks get added to some sound companies, some good fundamentals, but you should also have some companies that you understand that they're high risk and they're growth names, and you allocate a portion of your investments to those as well, but with very minimal investment, because again, they are high risk. Okay, so again, we did Carvana this week. If you guys like this video and appreciate it, make sure you guys smash that like button, subscribe, comment down below what stock you want me to do next, and I will make the video next week. Thank you for watching. I will catch you next week.